Hey, welcome to the live stream. Today is the evening of July 28th. We had some earnings announced today. A pretty good list of companies, not any giant ones. I think all the giant announcements start tomorrow morning, and we can talk about those as well. And it's going to be such a high volume of earnings this week. Starting tomorrow until Friday morning, I think there's going to be well over 500 companies that are going to announce. These are really important names across all industries: healthcare, tech, communication services, energy, you name it, it's announcing. Financials, huge financials companies. So it's going to be a huge week. Today wasn't much of a day if you consider that the S&P barely inked out a gain. And the NASDAQ did go up a little bit, primarily because the semiconductor industry did well today. Dow Jones was down a little bit, and so was the Russell, down a little bit. But there was no, it's on a day like that, it's just a couple of stocks, led the charge. NVIDIA, Broadcom, AMD. The semiconductor stocks did well. And I think it's the deal that was reached over tariffs with Europe kind of relieved some of the tension around tariffs that could have existed between the US and Europe. And there's an expectation that the agreement with China is on its way because they're meeting. They're going to have a meeting. I think they're meeting right now, and I forgot which country, but we have delegates from the U.S., from China, meeting, trying to iron out what they're going to agree on. That's going to help semiconductors as well as consumer discretionary. Now, that was nice and green. Maybe some software companies were nice and green. Tesla was green. Amazon was green. But it looks like real estate was real red. Materials were down quite a bit. Utilities were down. Tobacco was down. And then healthcare was down again. The only bright spot was United Healthcare. So telecom was down. Interesting. So just a couple companies made it out with a gain, but a lot of companies did not make it out with a gain. They kind of had a pretty good setback. So we'll take a look at, just across the board, some of the companies that announced today. We'll start there, kind of see what they announced, see how their stocks are moving, and see what the news is there. And then I'll go into tomorrow morning's expected announcements, and those will be announced before the market opens. So it'll be a nice active morning where we can dissect those and see what they have to say. If you would like me to talk about a stock, and it's a $5 super chat if you're not a member. If you're already a paid member of the channel, that comes with your membership. Just put that ticker in the chat. We'll take a look at it. If you buy a $5 super chat, I go all the way. Analyze the company, just really look at it from a big picture level, look at it against its peers, do an intrinsic value calculation, go through the full evaluation of that company to see, what based on my research, what that stock is worth, based on its cash flows, profits, make sure it has a good balance sheet, those kinds of things. So we usually get a couple of requests. Hopefully we get a couple of them tonight. I'm going to go through a string of stocks, but at any time, whoever puts a stock out there, it'll interrupt wherever I'm at, and I'll jump right into the request. So think about it. Let me know. And thanks for joining. Looks like we've got a good number of attendees already. Thanks a lot for joining. So just to kind of level set what's going on with the stock market, of course, it's earnings. There's some kind of, stories that just continue on, which is the Federal Reserve going to cut interest rates? And of course, the tariffs, right? Tariffs, the big news is as tariffs get resolved, we get some of that concern out of the market, which is good. But are they going to cut interest rates or not? That is really wearing on me. I'm really kind of tired of hearing it. It's either they're going to cut them or not, but I don't think it changes how good a company is going to perform. Looks like Mitch, you're on. How you doing, man? Let's take a look at what you got in your comment. You want to look at EOLS. Let's do it. EOLS. Super small cap, not profitable. All right, right up my alley. We had a terrific stock, and you're a member, so you can watch the member-only video. We had a member-only call on Sunday, and we talked about a few stocks, but one of the members came with a stock, and it looked great. So I made a video just for members. Hey, this is the stock that looked the best out of the member call. I encourage you to look at that one, but for now, we're going to look at EOLS. Let's take a look. EOLS. So Ebolus. Ebolus, a performance beauty company, delivers products in the cash pay aesthetic market in the United States, Canada, Europe, and Australia. It offers Jeuveau, a proprietary 900 kilodalton purified. Okay, let's take a look at their website. And these guys are headed in Newport Beach, California. All right. So these guys accept all cookies. Close that out. Okay. So this is, I think what they mean when they say cash pay aesthetics. This is where women go to doctors and practitioners, and they like certain treatments because it makes them look younger, maybe it enhances a feature that they have on their face, I imagine other parts. Yeah, like a Botox, that's what I was thinking. Botox is an AbbVie product, and doctors like cash because you don't have to go through insurance, you don't get these discounts automatically applied to your services, and that's what these guys do. Okay, that makes sense. And FYI, Botox, the product Botox, Newport Beach is right in kind of my area in Orange County, California. And Botox was created by a company in Orange County. The company was actually creating it to try to help with vision problems. Sometimes people have vision problems because their little muscles in our eyes, one might be too strong and it throws your vision off. So they would inject the Botox and somewhat weaken a muscle that needed to be weaker. And they found out, hey, it also removes wrinkles. And that's where it really became big. All right, so they have this brand, and man, this website is like watching a modeling tour here. So 4 reasons to choose a natural look. Okay, so wrinkle treatments. Okay, so maybe some of the scientists that created Botox said, hey, let's create a second generation of that, and we'll see how their growth is going, because I understand this business, and I did invest in AbbVie for some time, and I am familiar with Botox and the type of business it is. All right, so that's that. So we understand what the business is about. Now let's take a look and see if we can get to directly to their financials, because oftentimes I end up wanting to look at the financials and to give me clarity of the company. So let me get that kind of set up. Okay, so we'll go to quarterly results. Here's the quarterly result. Okay, this will be ready for us to go and look at their financials. Okay, So we understand this is a company. These are I'm going to call them medications or compounds that professionals will use to help women with their beauty. And I'm sure some men probably go in there, have them remove the wrinkles. August 5th is going to be their earnings date. So that's going to happen next week. Market cap's small, great. And their revenue, you're paying about call it 2.5 times sales, not bad. Now, a net income loss doesn't scare me away, okay? Lower caps, if you buy them at the right time, it's the right small cap. These things can make us a lot of money, so I'm not scared away. Look at this. That's the kind of discount I'm looking for. Discount of 155%, strong buy. All right, so let's take a peek at their financials. The growth looks good. 25% growth on the trailing 12 months, quarterly, 15% growth in the first quarter. First quarter last year was 42%. So the growth may be slowing a little bit, maybe driven. This tends, these cash businesses, they tend to be kind of a barometer of the economy. If people aren't feeling financially confident, hey, I'm not going to go have that $500, $3,000 treatment. These things are expensive. And they're like, I'm going to have to put that off because I'm not feeling, financially confident. So I can't spend that kind of money. This is not covered by your insurance. This is all out of pocket. You got to pay with your credit card or your checking account or some cash. Okay, so good growth, but it's slowing down. Let's just keep that in the back of our minds. Now I want to look at margins, okay? Margins are going to be really important. It's not a showstopper that they don't have free cash flow yet. So long as it's not like out of control. You see that it's getting better. They used to burn 93 million in a year. They're down to 19 million. Okay, so that's getting better. Gross margins are good. Okay, let me tell you why they're good. Is you see when they're smaller, 56, they're getting bigger, and this gross margin gets bigger, and that makes sense because as you get bigger, you develop economies of scale. Your scale enables you to be more efficient with your product cost. So this is headed in the right direction. I would say that if they keep growing, maybe they get to like a $5 billion revenue number. These gross margins will probably get to like 75%. Okay, so that looks okay. Now the balance sheet. The balance sheet could be a deal breaker for me. If they have a bunch of debt, I don't care if they have a good idea, I'm out. So they have 67, call it 68 million in cash and 130 in debt. So net, they have $62 million of debt. So they have a pretty good revenue number. Debt to EBITDA not available because they don't make money. But I'm going to say if they have, I can kind of take a swag at their EBITDA. So you see they're doing 275 cost of revenue. Yeah, they're fine on debt. Gross profits 188. They're okay. So okay. And they're burning 19 million in per year in cash. It's getting better. Okay, we got something to work with. Let's see what analysts are saying and how many. 5 analysts are rating this company. Okay, and let's see what these guys are saying. So strong buy. Okay, all right, looks good. They're all bullish on it. Jeez. Worst case scenario is you're gonna more than double your money. Best case scenario is you're gonna triple your money. That's not bad. Sign me up. So sorry. Sorry, got one of my sons is flying and he wanted to confirm something. All right, so these analysts are really bullish. So that looks good. So let's get into beginning to value this company. Now, I like that they're picking out a business. It's around beauty. That's good. Botox is a really important franchise for AbbVie. And I can understand that they now are going to see competitors like this come into the marketplace. The focus that Evolus can provide into this market is an advantage. AbbVie is this giant company. They have like 100 different drugs and compounds they're trying to market. Botox is just one out of that. So the lack of focus gives these guys an advantage. These guys are just going to probably make better products, communicate better with the professionals that are handling this product and so forth. All right, so we're going to open up a valuation schedule, and they're going to crank through the financials here. I'm going to kind of scan this with you on the stream, and then we're going to create a valuation. So the balance sheet, we kind of went over this through stock analysis. They have 68 million in cash right here. Okay, that looks okay. Okay, that looks fine. And here's that loan they have, 122 million. Okay, so that looks all right. Okay. Revenue, so we're expanding revenue. The 3 months grew by about $10 million in overall revenue growth. The gross profit did expand nicely by 15%. Looks good. Operating expenses. Selling and administrative, this is understandable because they're trying to crack into markets where Botox is probably well entrenched. So they're going to those professionals and saying, hey, our stuff's better. Let me prove it to you. Maybe they offer some discounts to get that doctor to try it. All right. So we have a loss, but do they have depreciation in here? Yeah. So very little depreciation. Understood. They're probably, based on that depreciation number, they don't own their own factory. They're outsourcing the production. They have developed the formula of the chemistry, and then they partner with somebody who's manufacturing. So it tells me that in the financial statements when I see the depreciation being so low. Okay. All right, so that's that. Let's take a look at, I think they'll have a statement of cash flow in here. Perfect. Okay, good. So they lost a little money, no big deal. And they have cash from operations negative 15 million. And then they have some purchases of plant, property, equipment, and that drove it down to, call it 16 million altogether. Okay. All right. So I'm gonna move, or actually I can just create another. I have another screen, and I'm gonna open up this website for this ticker on another screen, so I could read numbers off one screen and enter them into the valuation model on another. Okay, so I have plenty of healthcare companies to compare these guys against, and I'm going to look for a small cap, and I'm going to go with Catalyst Pharma. So Catalyst Pharma is a high growth company, and we'll use that as kind of like just the template that we can use. All right. And I like small caps. I like small caps that make us a lot of money, to be specific. Those are the type of small caps I like. I also like that, it's always a great story when small caps succeed. You see a small company go into a market that maybe a big company dominates, and a small player comes in and they're really competitive. That's always a good story. But the best of the best part of the story is that investors make a lot of money, of course. Okay, so we're analyzing this company. Today's date is the 28th. I'd like to kind of timestamp when I did the evaluation, because I share this research with investors that are members, and then you guys know when I did the research. So Evolus, perfect. So this is a small company. So you see how this is a small company, and the discount rate for a company that is large and low risk right now would be 7.5 to 8%. That would be the discount rate. That's the reasonable amount of return for the risk that we're taking. As you get smaller caps, you got to ask for a higher rate of return. I'm going to ask for a 12% rate of return because I'm taking a higher risk. Okay, that's what we want to do there. So this is where we need to put our thinking hats on. Okay, we probably all had them before we even met on this live stream, but they're not producing free cash flow. But what we could, intelligently do is we can forecast when they're going to be cash positive, right? They've had some, big negative number, or I should say some negative numbers, but the negativity is kind of going away. And they might be cash positive maybe in a year or two. If you kind of track this, right, let's go from 2022 to 2024. They improved cash, free cash by 60, call it $67 million. The difference between 86 and 19 is 67 million. So it's the right trend. Okay. So if I were to go 67 million, and I were to say that was the rate of change, that's a pretty good rate of change. So I'm going to say that they're probably going to hit, be even on cash in about a year and a half. And then from there, they're probably going to do about 25 million in free cash flow. And then that's going to grow very rapidly because these small businesses will grow their cash flows quickly because as they scale up, their costs go down, and it's a good thing. And I could say that because I've analyzed dozens of companies in this space that are small caps, like Catalyst being one of the examples. Okay, so we're going to go so the trailing 12, excuse me, the forward 12 months, I'm going to say is going to be 0. Okay. And I'm going to label this my forecast. Okay. And then in year 2, I'm expecting they're going to do about 10 million. Okay. And then in year 3, I think they're going to add like good chunks of cash flow. They're going to do about 40 million. And then from there, actually, that's kind of a step up. Let's go 30 million. And then we'll do 50 million. And you can see that I'm kind of throwing this, I'm not going to use growth rate here. I'm going to put a non-applicable here because I just kind of broke the model because I'm kind of using my forecasting sense to kind of just see, is this going to be discounted? All right, so the terminal value is going to be 650 million. I think the long-term growth rate is going to be high because they're so small. So I'm going to go with 5. So the intrinsic value of this business is 400, based on cash flows, 487 million. Now they had, I think it was 68 million in cash and 121 million in debt. And let me check that. $68, and it was 130. Okay. So the equity value is 425. Now, how many shares are outstanding? So we have 64 million shares outstanding. So 64.48 million. So based on a natural forecast, kind of like a forecast that I could put together, this stock's a little expensive right now. And I could also say that based on the forecast I'm willing to put on this company, it's priced too high. But things are going to change very quickly for this company as they announce earnings and they change, and maybe they show that, hey, we're going to be cash positive sooner. That would help their value. Or the other way, if they're like, man, we're running into way too much competition, it's going to take longer to be profitable. Well, that means the value is even lower. So let's leave that number there. Now, they don't have any earnings right now. This guy's zero. So right now, this would be a good watch stock for me, but it wouldn't be an investment. I need to see better data. Now, here's the situation where this could be different is, you know, Mitch, I don't know what you do for a living, but let's say you're a chemist and you've worked at a pharmaceutical company for 10 years and you have the expertise to know, hey, these guys are really special. They're very different. And I really like them because I think they're going to really do well in the market. Okay, that's a knowledge advantage you have potentially. That's the case, you can better the valuation. Okay. But for me, I'm not a chemist. I'm just a good stock investor. And this is what I'm willing to put forward as a forecast. This would be a good stock to watch. I like their size. I think their size has potential because it's stocks like these. I mean, we don't need this thing to go to $20 billion in value. We just needed to go to $3 billion. If you go to 3 billion, this thing will 7-bag your money. That'd be wonderful. But we need them to keep growing. One yellow flag, not a red flag, is their revenue is slowing down. Remember that part. When we go to the quarterly, we see that, hey, 15%, that's a lot lower than last year. They were at 42% growth if you compare the year-over-year growth. This is a yellow flag. What happened, guys? How come you're slowing down? You're still relatively small. Are you seeing Botox push back and say, compete against you? That might be the case. Well, that would be a problem. If they can't grow, this company's not as valuable as it could be. Gross profit, I like their gross profit. So this one just needs to stay in the oven a little longer. It's kind of like, you know, when you bake something, you just need to get for the right amount of time. This one needs to stay in the oven and keep growing, grow its gross margins, get to free cash flow status. And you know what? Let's do this. One more checkpoint. So we saw the financials, which is fine. This looks fine. But I'd like to see what their press release had to say. What I'm going to do is I'm going to try to see if they're talking about free cash flow and see if they're commenting and management saying, hey, we're going to be cash positive this year in the third quarter or something like that. That's the case. That'd be interesting to consider. So they're growing. So I'm not seeing any comments on free cash flow up there. Let me Control F and see if maybe I missed it. So that's the balance sheet. That's how much cash they have. We got that. We got that. And then this is, yeah, it doesn't seem like they're commenting. Usually when a business in their state, when they're small and they're they're looking at, their future and saying, we're probably going to be cash positive in a quarter or two. They'll announce it to the street, be like, hey, we're going to be cash positive, but they didn't. So those are my comments on that one. It'd be a pretty interesting watch stock, but it's not going to receive any of my capital. It's just not ready because it could take a turn for the worst. And that would not be good, right? We want it to take a turn for the better. I'm going to save this guy, and on the next update, you'll be able to see this on the shared folder where I show my research. You'll be able to see this. So give me a second here. I just want to make myself a note to add it. I'll come back later and fill it in. But for now, I just need to know that, hey, I need to finish this later. All right, we're off to the races. We just analyzed a small cap. I love small caps. I love small caps that make us a lot of money. And this one here, I think, could make us a lot of money if they just keep improving their business, keep growing that business, get to cash positivity, keep making your product better. Okay, so, all right. So Robinhood gains, man. Robinhood's been a super winner for me. All right. Yep. And if you invest in this company, you may want to just get familiar with AbbVie, kind of be familiar with the competition, right? And this is the competition. Oh wait, I went with the wrong ticker. Sorry. It's AB. Is it two B's? AbbVie or two B's? AbbVie. Yeah, this is it. So AbbVie is, I'm going to call it a very large, successful company. They have all kinds of different drugs, but here's Botox as an example. You get familiar with their business. How are they marketing it? Are they growing Botox? How fast is Botox growing? If this is a high growth area for them, then you're kind of going to the right, like market, because this is an expanding market. And this is the company earlier that I couldn't remember, Allergan. Allergan was the company that they were acquired by AbbVie, but Allergan operated in Irvine, California. It looks like they're still there. And they're the ones that innovated Botox way back when. All right, good one. Thanks for asking. And let's keep an eye on that one. See if it, after maybe an earnings or two, we start seeing better fundamentals, and then the valuation gets better. For Algorithm, thanks for the comment, man. I appreciate the comment, really do. And that's why I do this. I want to bring together investors, and I want us all to get better. I want to get better. Let me tell you, sometimes somebody on the stream or in the member call comes up with like a really interesting stock. This one didn't pan out like to be a super winner potentially yet. Maybe it is in a quarter or two, but I've made some money on some stocks that we found. So it's a two-way street. But I also appreciate that I'm educated in accounting, have an MBA, have worked professionally for a long time. And there's probably a few things that I could teach that I would want you guys to learn and kind of go through the journey of being an investor, go up the learning curve faster than I did, because today's day and age, you guys just have bigger advantages than I had 20 years ago, because this information is so readily available. YouTube is a great place to learn. So that's why I'm doing this, man, and I really enjoy it. Bogey, have I heard of Fix? You're up 90% on the position. Nicely done, my man. Nicely done. So it's Fix, huh? Comfort Systems. Are these guys, they do mattresses? No. Comfort Systems. So mechanical and electrical, when I hear mechanical, it's like air handling, like air conditioning and so forth, and then plumbing. Okay, that makes sense. So these guys, engineering, construction, industrials. And you're up nicely on this one, huh? Are these guys working in data centers and they're doing the cooling in data centers potentially? That might be why. Yeah. Some of these, if businesses are tied to the data center, they're just kind of screaming up. They're doing really well. Congratulations. Nicely done. All right. So, Brandon, good to see you. I have I used AI in to do some of my analysis? And the answer is yes. Now, I haven't gone like I did a video. This is maybe 9 months ago to a year ago. And I actually tried to go through and like my methodology, it's a methodology. It's like, hey, look, find businesses that are terrific. Find a business that's terrific that I think has competitive advantages, really strong barriers of entry to keep competitors out. They're growing really fast. They have terrific profits and they have terrific cash flow. All those things are not like, you know, um, not difficult to find. You just need to know where to look. And I was trying to get AI to kind of, kind of shortcut the process for me. And it did provide some good data, but it wasn't able to do it all the way. I'm going to keep trying, and especially with now agents, right? You can create an agent and have it build it for you. But I'll give it some thought and see if I can give it another crack. I did create a video of showing which AI apps provide the best data, and that was like 9 months to a year ago. And back then, Meta ranked well with financial data. Gemini did okay. OpenAI was okay. DeepSeek was good. They all were useful, but I would say that so is Google search and so is stock analysis. And once I have a process and have a recipe for success that works, I don't want to completely abandon it. I want to keep making money. Now, if AI can kind of help me do it quicker, faster, and more often, I'm all for it. I'm going to try to figure out how. So I have looked into it. And my son is, he's 20, so he's been using AI agents in really creative ways. And I'm like, man, that's pretty cool. Maybe I could do that with my stock analysis. I could just kick back all day and click a button and have AI do it all for me. Paul, how you doing? How many stocks do I own? I own probably about 50 stocks, and I own one like probably my top 5 stocks are 50% of the value of the fund, and then I have some stocks that are in the middle, and I have some stocks that are just started positions on. But yeah, if you become a member, I usually go through my portfolio with members on member calls, and you can take a look at that. All right. Nicely done, Bogey, on your investment there. Looks like a real winner. All right, cool. So we're moving and grooving. Again, if you guys want to see other stocks, please mention it in the chat. We'll talk about them. If you're a member, I'll do a deep analysis on them. If you want deep analysis like we just did on that one stock that we led with, $5 super chat. If you're already a member, it comes with your membership. So I'm going to keep rolling on some stocks that I wanted to take a look at. And okay, again, I want to talk about the stocks you want to talk about. So I'll interrupt my flow here as soon as you guys give me more tickers. So here we are. We are at July 28th. And Welltower announced, we'll take a look at what Welltower announced. Waste management, right? These guys do waste management, like the name says. The Cadence Design, these guys had very good earnings. And we'll talk about Cadence. And I think there's a couple others that I picked out. Nucor did not have a good earnings. They're selling off. That's a steel company. We'll see what they had to say and why they're selling off. I think those are the names that I wanted to cover there. And then once we're done there, I'll come back and we'll go through the morning and what's going to be announced in the morning because there's some big names coming out in the morning. All right, Welltower. What do these guys do? Welltower is one of the world's preeminent residential wellness and healthcare infrastructure companies. we seek to position our portfolio of 150 plus seniors in wellness housing. Okay. So these guys are real estate investment trusts. They do housing for older people. They're maybe retired. And I have a REIT that's done really well, CTRE. Similar space. CTRE does properties where people go that are typically older, that they need to stay there maybe for 6 months and receive some type of medical attention. And that is a big necessity. And CTRE has done fantastic. So these guys here over the 5-year, they've done fantastic. So this is a segment, right? We have a population in the US that has a lot of people of 60 or plus, big population. So they need properties like these. So no big surprise that these guys are doing really well. It has a market cap of $103 billion. They're selling off a little bit, but not much, just 0.13. And revenue is 9.28. They pay a small dividend. For a REIT, this is a small dividend. And it's probably because their stock price has gone up so much. As their stock price goes up, your dividend yield goes down because of the mathematics, right? So that's what's going on there. P ratio is really high. So this one might be a little too expensive in my book. And when you do REITs, you don't want to look at cash flow. It wouldn't be the appropriate thing. You want to value them on the earnings per share, and you want to make sure that their funds from operations can afford the dividend. And those are the two things you want to look at. So this one here, it's not really floating my boat because the big part of investing in a REIT is getting a nice dividend. And 1.69 is not a good dividend. And I would just be like, no thanks. I'll move on because I can get a better dividend from, and I think CTRE still has a nice dividend. This has been my investment, 4.39. It's done not as good. It hasn't done as good over the 1 year. It's done well over the 5-year. So this one here has that dividend that's a higher rate. Maybe this one's going to start taking off and catching up with WellPoint. So this one here is not, this would be for an older investor that wants an income stock. This would not be for a young investor. Young investors, you don't need real estate investment trust. Unless you want your money to grow slowly. Younger investors, I would think, want growth stocks. You want something that can double your money every 3 years, every 4 years, every 5 years at a minimum. And these here, they're kind of slow growers, typically. That one's done really well. So let's talk about waste management. I think we all know what these guys do. And looks like Mitch has a question about Tyson. I used to own Tyson, correct? Yeah, well, Tyson Foods, let's talk about Tyson, and we will open up another session here. So Tyson Foods, they grow and distribute proteins, chicken, beef, pork. And over the 1 year, not doing well. Over the 5-year, not doing well. They were doing well coming out of the pandemic because we had significant inflation on food, if you recall. There was inflation on food, and Tyson was able to raise their prices and grow their revenues. But what they have experienced, to see that growth, that's all inflation into their numbers. And then once inflation was tamed, these guys haven't been able to grow. And this is a food stock. These are referred to as safety stocks. They do really well in recessions or when growth stocks are really losing a lot of value. Investors will run to stocks like these. Now, I haven't invested in Tyson for some time. Their growth rate isn't great. Let's take a look at their other fundamentals. Free cash flow at 1.2 billion. Okay, looks pretty good. 1.5 looks better. Gross margins are really low. It's the food industry. It's a commodity. So this is where it starts getting less desirable. That's really low. We saw that Botox competitor at nearly 70% gross margins, right? That's the kind of business I'm really attracted to. High margins, high profit, high cash flow. So these guys don't have high cash flow, really low cash flow. So nice dividend. I would be sure that they can pay for that dividend. Let's see what their dividend payout ratio is. That's pretty high dividend payout ratio. So that's kind of scary. I would not invest in Tyson. I'm not seeing fundamentals that I'm excited about. I don't want my money just sit around not making money, not appreciating. The one company that I'm in, Staples, and you seem like, based on your picture, you seem like a younger investor. Again, this is not like a young investor kind of type of stock. This is more of an older investor. Hey, I want to protect my wealth. I want to protect my portfolio. I don't want it to go up or down very much. And I like dividend stocks. Great. This might be a good idea for you. But for a young investor, it'd be like, no, let's go find the next NVIDIA. Let's go find the next Palantir. Let's go find the next Robinhood. Really grow our portfolio when we're 20 to 40. And once we hit 50 to 60, 65, we got to be conservative because we want to protect our wealth and we want to have our money there when we want it. Maybe we want to retire and travel quite a bit. Well, we want that money to be there. We don't want to take too many high risks unnecessarily. So this one here is not floating my boat. What does float my boat is Kroger. If you want to have a food stock, these guys do food. They just don't have ranches with cows and chickens and so forth. And these guys get it done. Those are good numbers. Doubled over the 5-year. Pays a small dividend because it's been appreciating. But this is a safety stock and it's doubled. And Kroger, I know it's a boring business, grocery stores, but as I research Kroger, it's a really well-run company. Really well-run. They're big. They got good size. Warren Buffett's an investor in Kroger. So that's what I'd rather do in safety stocks instead of Tyson. So Tyson would not be anywhere near my portfolio. Thanks for asking. And I'm always going to give you kind of like how I see things. And it's not meant to be anything else. Brandon, DSP, starting to work finally before earnings. So DSP, DSP is a small cap, which is good. And man, we're talking about another Southern California company. I think you guys know that I'm in Southern California. These guys are headquartered in Irvine, and I've driven past their headquarters a couple of times. And these guys, they help companies, as you guys know, the way businesses market now is they're putting up ads when you're watching a YouTube video or you're watching an Amazon Prime video and it shows, commercials, or you're on Facebook and you see these ads kind of around the pages. That's what Viant does. It helps businesses kind of place their ads and optimize their spend with marketing. They're a really small cap. Look at that, less than $1 billion. Revenues 306. Now the best company in the space is AppLovin. This is a small version of AppLovin. Analysts believe it's discounted. Okay, they're going to announce on August 11th. So that's call it 2 weeks from now. And their growth is good, 30%. The piece that is not as good as AppLovin is their gross margins. Not as good. But they are discounted. I count on the stock. And free cash flow is good. This is a nice little company. And what's strange is that DSP, I think, is kind of not given a lot of attention by the market. It's down 22%. Everything went down in March. Okay? They're not the only ones that went down in March, but they haven't come back, right? But if we compare them to AppLovin, that gets more attention because they're bigger, way bigger. This AppLovin's kind of picked itself up a little bit better, right? For the year to date, AppLovin's in the green, Viant is in the red. But that doesn't mean it's bad, because this is the rear view mirror telling us what happened in the past. You know, the Viant might be a good pickup, but it's tough right now because the market's really expensive. You know, it's expensive market. DSP's discounted. The market's not buying it. So I think long-term DSP is going to be a good hold, especially if they keep growing at 30%. They keep growing at 30%. I think it's going to be a good-looking company in the future. Maybe even get acquired, which would be a shortcut to a nice payout. I think it's discounted by 19%. It's not a wild discount. It is at a rate of return of 10%, so that's really good. But you're looking at a small cap, right? If they have like a really good earnings, bang, this thing is going to go up. It could be a nice acquisition target for another business. And then investors would wake up one morning and say, hey, these guys are being acquired by somebody else. They're going to pay you 50% more than the stock was priced at yesterday. And you're like, hey, I'll take that. So Viant's a neat little company. I'm watching it, keeping an eye on it. If it starts to rally, I'm going to buy it. It's okay to be late on it for me. But overall, the cash is there. It's discounted based on cash flows. Their gross margins are not as good as AppLovin, which affects their profitability on the earnings per share level. You see their gross margins are 5%. And if we open AppLovin, AppLovin's margins are way higher, which enables them to have better earnings per share. And AppLovin's like $120 billion, I believe, in market cap. So this one here, you know, let's look at the 5-day. It's working for 5 days. Working for the 1 month, looks good. Hopefully it continues to rise and they really crush it on August 11th. Remind me, we'll analyze it on August 11th. We will look at this thing backwards and front. Okay, so, all right. DSP. And I drive by their office. My wife and I, we like to drive out to the beach, and there's if you guys are familiar with Corona Del Mar, it's beautiful there. We like walking down there, and the Back Bay in Newport Beach, and Viant is on Jamboree on our route to those areas, and I always look at them and go, yeah, I know that company. I've analyzed it. All right, cool, Mitch. Thank you so much for that comment. For algorithm. So A-Lab was the only bold stock you backed. Well, yeah, thanks for the feedback. But you don't have to go on the time machine, but I kind of made a bold call on Robinhood. That worked out great. And when it was well ahead of their profits they've made. I kind of saw it, you know, early, bought into it. It's done great. I would say that the stocks that I think are smaller caps, bold statements, Futu's been a rock star stock. Don't know if you've heard of Futu. Futu Holdings. This one here has done nicely. 1 year, 165%. This has been, and it's in the market's just been so generous to us. You know, this is a really good business. It's basically Robinhood in China, in Hong Kong, and the market sells it off so you can buy shares, and then it cranks it up, and then it sells it off, buy shares, and it cranks it up. Beautiful. Thank you, stock market. So this is another bold statement, I guess. Market cap 15 million. A-Lab is a beautiful stock. want A-Lab to multiply my money times 10 when we're all said and done. But thanks for picking that out. Keep giving me feedback like that, and keep watching my videos. I think you're going to find that I do really like small caps. I bought this tiny cap. This is maybe one of the smallest companies I've ever invested in. And so I bought these guys back here, like for $2 a share. And they ended up going to $9 a share. And this is a tiny cap. Now they're 331 million. When I bought them, I think they were $160 million market cap. They did great. And I loved it because it was such a small cap. It was almost, it felt like, hey, all right, cool. I'm helping this small company, really thrive. And man, mission accomplished. Thank you so much, Panel. And then I had Big Five Sporting Goods, although it's been a crummy investment since the short squeeze, but there was a short squeeze on Big Five here. And I couldn't sell this stock faster. I sold it at $40 a share, and I bought it really low. So this one was a really good one. And there was a short squeeze there. And then there was a short squeeze on this other stock. But this is, I did think it was discounted. I did think that this one was being left out as just complete garbage, and I didn't agree with it. So I made like a really nice return on this, and the short squeeze. So, but hey, you can't get lucky if you don't play, right? So, yeah, small caps, man, they're great, but big caps are great too. I'm not gonna give back all the money I've made on Meta. I'm not gonna do it. Even if they ask me nicely, I'm not gonna give them the money back. I've made dollars and cents. I've made in the portfolio right now. I've made more money on Meta than any other stock. I've made a lot of money on Robinhood. I've made a lot of money on Uber, but I've made more money on real estate. Real estate it's a leveraged investment. So I've made on one asset, I've made really good money as opposed to stocks, which I don't leverage. I don't use leverage on stocks. I'll use it on real estate. So good stuff, man. I love investing in stocks, finding good winners. So what stocks do I suggest for young investors? Okay. So I'm going to answer that the way I would want somebody, let's say I'm going to go in the time machine. I would put myself in, imagine I'm 22. I want to teach you how to invest versus tell you, oh, you should buy A-Lab. It's a great stock, right? Because what I would want you to do is like when you're 22, you learn something. And then when you're 32, you're 20 times better. And then when you're 42, you're just killing it. You're making more money. And when you're 52, you're like, oh my God, I'm really good now. Like I'm making more money than I've ever made from my portfolio. So let's talk about process. So for a young investor, I would say that you want to find businesses that have a lot of growth. And so first off, try to improve your knowledge, awareness of industries, right? And pick a couple of industries. For sure, study, technology, because it's just been such a hotbed for good stocks. Communication services, another hotbed. But try to really understand, what makes a good business, and want to cheat code to that to finding out what makes a good company. Well, let me show you the cheat code. You go to the most valuable businesses on the stock market, because NVIDIA was a small cap at one time. So was Microsoft, Apple, Amazon, Google. But when you study these, you realize that all these businesses have something in common. When you go to their financials, they're growing. They generate insane amounts of cash flow. Look at this cash. And they're growing it. See how in 2018 they were at 32 billion. Now they're at $69 billion, $69 billion of cash. That's a giant pile of cash. So that's an example of Microsoft, right? So growth, high margins, high cash, great balance sheet. Okay. Now let's apply that to small cap. And that's when we find small caps. It starts with finding a business we believe in, right? So A-Lab. A-Lab's a semiconductor company. Okay. They're small relative to Microsoft. Microsoft's gigantic, over $3 trillion. Now, I know semiconductors well. I've invested in semiconductors for a long time. I've invested in TSM, Broadcom. I've invested in Intel, Qualcomm, made a lot of money on TSM, made a fair amount of money on Broadcom, not a ton of money, but some. So I know how to invest in semiconductor, and I know the space. Within data centers, I know that space as well. And Astera Labs is a semiconductor company operating in the data center, providing semiconductors to help with the communication between two different clouds like AWS and Microsoft Azure. That's a very big necessity right now, huge necessity. So I understand big picture, Astera Labs has something the market really needs. So much that their revenue is growing at 200%. Okay, so remember the lesson that I just kind of covered on Microsoft. High growth, high profit, high cash flow, great balance sheet. Okay, we can check the box on revenue on this one. Okay, they're growing really fast. Even though they're small, 200% is impressive. And they're generating free cash. A young business generating free cash. We looked at that. I'm going to call them a pharmaceutical company early in the stream. They were not generating free cash. They're a young business. These guys are. That's how, because they have high margins, high gross margins, high profitability. So they have semiconductors that everybody wants. They get to price them up because there's such high demand for them. They get to make a lot of money and a lot of cash flow. So Microsoft, high growth, high cash, balance sheet's great. So we check the boxes on growth, cash, looks good. And going at 200%, that cash is just going to go through the roof. Let's check that balance sheet. Make sure we're not going to buy a sick business, an unhealthy business. All they have is cash. They don't have any debt. That's a pristine balance sheet. That's perfect. No debt. So back to a young investor. Learn to identify an Astera Labs. And you can learn by studying Microsoft, NVIDIA, Apple before they stopped growing, Meta, Google, Amazon. And not necessarily because you're going to invest in them. They might be a good investment for you. But you just want to understand the DNA of what a great business looks like. Then we go through and start, going through these companies. Like we went through this company earlier in the stream. And this is part of, you've heard the term prospecting, right? When miners would go prospect on, a mountain and try to find gold. Kind of in the prospecting phase. We did a full analysis on this guy. It just didn't have the right fundamentals, right? It has the growth, but it's not incredible growth. It's slowing down, but it's growing. These guys are, I think, smaller than A-Lab, and they're growing slower, but it's still growth, so that's good. But once we get into this section, this is where we were not checking the key boxes, okay? Negative cash, okay? Not a showstopper. Gross margins are good, but this one's not, it needs to stay in the oven a little longer. So as a young investor, if you can learn to kind of, okay, this business is interesting, but not investable yet. Astera Labs is totally investable. And even then, you have to know, when should I buy it? Well, the market, it does us a favor. It delivers volatility. I love volatility because the market is irrational at times by cranking up stock prices and making stock prices go down. And it did that in the springtime. And it knocked on my door, said, "Hey, how would you like to buy a Sterilabs at $55 a share?" And I said, "Yes, I would like to do that," because I did my homework. And boom, made a nice gain. I think it's going to keep going up. So as a young investor, that talk track, that that stream thought that I just went through, if you can devote yourself to trying to learn that, you're going to make a lot of money. If you're just kind of looking for a list of stocks that are good, I think you're going to have, some luck. Some stocks are going to work, some stocks are not. But I'd rather you build in a portfolio of like 20, 30, 40 stocks that you feel like these things are freaking solid. Not all of them are going to be perfect. Maybe 10% of them are dogs eventually, because not a lot of these companies are going to surprise us, like Apple. It's now a dog after being such a star for so long. But if you are in your 20s, I'm going to guesstimate you're 22, and you wake up 20 years from now, with the skill set of being able to construct a portfolio to just grow your wealth, have great income. I mean, that'd be awesome, don't you think? And you can do it. You're on this channel, you're on this stream, you got really good information on YouTube. Know what information is useless, know what information is noise, and then just appreciate, love the rigor. It's like sports, right? A lot of people love the toughness of sports, how you have to just really pay the price of being a really good athlete. Pay the price of being a great investor. Enjoy the rigor, and you'll become a great investor. All right. So we're rocking now. All right. So that's Paul's question. Thank you. Good question. Let's keep rolling here. We got a lot of people on the stream now. So we're analyzing companies. We're kind of going over some companies they're going to announce tomorrow. We've had a nice conversation around Evolus. Man, that name doesn't grow on me very quickly. All right, so a company that did announce today that had very good earnings is Cadence. They updated and improved their guidance. Why are you not getting a job in investment like portfolio manager? All right, so I'm going to answer that question. So first, when I was like in my 20s, I did think, I'd like to be a portfolio manager someday. That'd be kind of a cool job. But I found the software industry, and I made a lot of money in the software industry. Really interesting. Implemented software systems for big companies, variety of companies, and I've loved it. So I've had an awesome career in software. Do I want a career as a portfolio manager? No, I think I'll just manage my fund, and I'm good. Maybe I'll start my own company and do that someday, but not today. But question, it's always been an area of interest. I've always liked stocks and stuff, but I love software. It's been an awesome industry for me. And we get choices, right? When you're young, there's probably 20 things you want to do, and you got to pick one. And I picked one that paid me really well. It was a great place to grow. I've always grown over the last 30 years in the software industry. All right, Cadence Design. Back to Cadence Design. So these guys are in the semiconductor space, and they have software. Like when you design a chip, you theorize, you're like, okay, this chip is going to perform at this level. It's going to do this level of performance. Well, you've theorized it. Now you got to test it, and you use Cadence Design Systems to test chipsets. And then you're able to validate, hey, this chip will perform at this level. Here's my Cadence Designs kind of output and test output, and the industry will believe you. So that's what these guys do. Now they make money when the semiconductor space is really booming, and it's booming, especially for GPUs from NVIDIA. AMD is doing well. They're growing really nicely, and a bunch of companies are booming. So these guys are growing, and they upgraded their guidance. So they raised their guidance, and that's what the market really liked. The 1 year, these guys are up 29%. Looks good. Tomorrow, they're going to go up another 6.66%. 5 years, they're up 217%. Nice. Very good. So market cap, 91 billion. Looks good. Nicely done. PE is expensive. A lot of these semiconductor stocks are now expensive, right? PE ratio is 84. When we look at their growth, 22%, that's decent. And they're still kind of small, 5 billion. 22% is really good, especially since they were growing in the teens, but now they're at 22%. They're 20% on the quarter they just announced. So it looks good. Nicely done. Cadence Designs' stock's going up. Gross margins, 85%, looks good. But free cash flow looks okay. I'd probably want to pay like maybe 60 billion for the company, and they're way above that. So this is a really expensive stock. Too expensive for me. I like buying them when they're priced right. So these guys here are too expensive. We get choices, okay? We get choices when to buy stocks and what we think they're going to be valued in the future. This one at some point, I think it's going to give up some of these gains. And you can see that it's kind of plateaued up here. It stayed up here for, I guess, about a year and a quarter. And now it may break out, but it's still priced expensively. It's rather expensive. 14 analysts cover it, and I'm not the only one saying it's expensive. Some analysts are saying it's really expensive. And you have choices in semiconductor. The goal of investing is not buying what you think everybody's buying. It's buying the best price stocks that are going to go up, because if you buy right, you're going to make a lot of money. And especially if you buy small caps that really grow, that's where there's really good returns. So Cadence Designs, they announced, this is a wrinkle of good news. It's a smaller company. It's not NVIDIA. It's not Broadcom. But this is showing signs that the economy is very good in technology. So that is Cadence. A related company, Rambus, is also a semiconductor company. Okay. And they do DDR memory. So they do memory. I think this space is less profitable. We're going to double check that. This is a smaller cap, 6.9 billion, 33 PE. Revenue's 605 million. So you're paying 11 times, 12 times revenue. And whenever you have revenue above 10 times, it's kind of in the expensive zone. If you're like 50 times revenue, it's really expensive. Below 10 is usually okay. It's very rational. So these guys, so gross margins are really high. Wow, that looks good. $200 million of free cash. Man, this one's priced right. Yeah. 35% growth rate. Yeah, they're worth about 60, 70 billion dollars. I'm doing that in my head, just taking their free cash flow, multiplying it times 40. These guys are priced right. Looks good. Good job, Rambus. Analysts think it's discounted by 21%. They're going to open tomorrow 5% higher. That looks good. Year to date, this one's up 21%. 1 year, it's only up 8%. So it's not doing great for the 1 year. 5 year doing stupendous. Good job. It's plateaued, kind of like what we saw with Cadence. It's kind of had this kind of ceiling. Market's kind of waiting to see, are these guys going to keep growing? Well, they delivered nice growth. Good job. So Rambus is looking good. So the semiconductor stocks are looking good. Nicely done. Nucor, steel. And steel, really low valuations, 33 billion. These guys, I think, were doing good. Yeah, 23.8. And this was on a lot of news, right? Expecting that, hey, these tariffs are going to protect Nucor and they're going to be able to raise their prices and so forth. Now, their earnings were not good, based on judging from the stock action, right? Went down. So almost 1-to-1 on revenue. PE is 25. That's a high PE for a steel producer. It should be around 10 to 15. They're a strong buy, but it's only discounted by 5%. So here's their earnings. Their revenue dropped. Oof. Well, actually rose by 4.69 in the quarter, but you see a lot of red here. Yeah, this is not a good investment for me. Just not a lot of momentum in this space. This is an industry that it takes so much capital to run. I don't think it's going to flourish over time. 1 year it's down, 5 year. It's done well over the 5 year. I guess because it was priced so low back here. But the 1 year tells me a different story. So Nucor, big steel is down. Procter & Gamble, now we're getting into the territory of companies that are going to announce tomorrow morning. So we'll do a quick flyby and see the companies that are coming. Visa is going to report after the market closes, so I won't cover that one. But Procter & Gamble is a big cap staples company. And if you go to your bathroom or kitchen and laundry room, you got a bunch of their products. United Healthcare, really important earnings for United Healthcare. They're going to announce in the morning. AstraZeneca, pharmaceutical company. Merck, pharmaceutical company. Boeing is going to announce in the morning. And then Spotify. This is an expensive stock. I love their service. I've been a Spotify customer for some time. It's just an expensive stock. American Tower, this is a REIT that owns assets that enable us to use our mobile phones. United Parcel Service, that's a really important company to watch because they tell us about the economy, how much shipping is happening, how much logistics is happening. PayPal is going to announce. Really looking forward to seeing that. Just a lot of names. Geez, how many companies? 151 tomorrow, 250 on Wednesday, 263 on Thursday. So we got 700 plus companies announcing this week. Wow, that's a lot. All right, Procter & Gamble. These guys are very little growth in the company, right? And yeah, very slow growth. So this is a very safe stock, stable stock. Good for an older investor that wants that dividend, stable, stock. But again, I showed Kroger. Kroger's getting it done. These guys, not so much, right? 5 year doesn't look good. 1 year doesn't look good at all. So Anthony Ferguson, it's the playoffs for sure this week. Yeah, it does feel like a playoff week. Yep, most definitely. So Procter & Gamble will announce tomorrow. It's a big cap, but this one here is it'll do well when we're in recession. Like if we look at the 2022 year, and it didn't do very well in 2022, so I take that back. I was going to say it probably did well during that year, but it didn't. This one's just I don't know what to say about it. It's not the right stock for me. Visa, after the market closes, Tony, you're right. It's going to be super interesting to watch that. We'll see that after the market closes. United Health. This one is, man, a lot of eyeballs are on this one. This one was way up here, deservingly, and it's way down here. I don't think they deserve that. But if they have a solid earnings, it could pop to 350 in no time. And this is the earnings that I'm getting up in the morning, and this is the first one I want to analyze. May not be ready. I may have to hit Spotify. Spotify is located in Europe, so they'll probably release it like at 2 in the morning here in the US. But United Healthcare, man, I cannot wait to get my hands on it. This one here is it means a lot to I don't have a big position in United Healthcare, but I owned a lot of this stock like 7 years ago, and I had a really good run with it. Sold it like 3 years ago, 2 years ago, sold at a really good gain. And I just find it completely unbelievable that this stock is down so much because the business keeps growing. When a business grows, it shows that customers like the service. They like the health insurance that they provide. They're getting more customers. They're getting more people insured with United Healthcare. That's very telling. And you look at their cash flow. Remember when we looked at Microsoft? What makes them really profitable? What's very valuable is cash flow. Look at the gobs of cash flow these guys make. They went from 13.6 billion in cash to 24.8. That's really good growth in cash. So why the heck is the stock market lowering the stock price so much on United Healthcare? It's because the stock market from time to time is irrational on the way up and on the way down. This is irrational in my mind. We'll see. We'll see how quickly this thing recovers. But tomorrow is a really important day. I'm hoping they have a very good day, and we'll see. United Healthcare. Then we got Pharma. Big Pharma's discounted. This one here doesn't have a really big dividend, but this company's out of the UK. Year to date, doing okay. 1 year, not doing well. Pharma hasn't done all that great for the last couple of years. There used to be a time when they were just printing money, just really good, valuable businesses. These guys will announce their earnings will come out early because I believe they're in the UK. Maybe they have a US headquarters, but I believe their legacy is in United Kingdom. Yep, that's the company that I'm familiar with. So we'll see AstraZeneca out early. Merck, they're on the East Coast. They'll announce before the market opens. These guys have not been doing all that great. And that's kind of going to be a broken record on pharma. And it's amazing the kind of money these companies make, but the market just is not buying them. Boeing, airplane business, it's doing good for the 1 year. Year to date, it's doing stupendous. Look at that. 5 year, not so good, but giving you really good opportunity to buy at low rates. I've never been overly impressed with Boeing. It just seems like they always got something screwed up with them. It's like, geez, look at it's not even growing. What the heck? Well, it's growing the latest quarter. That looks good. And I think the story has changed, which is aerospace and defense. Defense, especially, has gotten really hot because a lot of countries are going to have to defend themselves. They went from really benefiting from the U.S. defending a good part of the world and United Nations kind of helping them, helping smaller countries have defense. Now they have to buy their own defense. So I think it's going to create a bigger economy for Boeing and other defense contractors. So these guys are going to announce in the morning. We'll see that. Spotify. Look at that. God. Incredible. And really, it's happened over the last year and a half or so. But this one's hard for me to price because it's a $143 billion market cap. Revenue is $17 billion. PE is really high, 116. Whew. Analysts still think it's priced okay. Their growth is pretty good, but it's not great. And their free cash flow, 2.6 billion, that's good. But the best I can do from a valuation perspective, see their gross margins, not great because they have to pay a lot of artists when they play the music. And I can maybe go to 50 billion, maybe 70, and they're way up at 143. So I haven't been able to get into Spotify. And that's okay. I did great with Netflix. Just made a lot of money on that one, sold it. And I know when to buy and I know when to not buy. And this is one where I know I shouldn't buy it. I don't care that I like the service. It's priced too high. At the end of the day, we're buying companies that produce profits and cash. And this one doesn't produce enough cash. Their gross margins are at 31%. So I'll keep listening to awesome music on Spotify and keep my capital elsewhere. American Tower, this is a REIT and not a very big dividend on the REIT. Year to date, it's up nicely. 1 year, not so nice. 5-year, terrible. So not sure what to do with this one. There's a lot of good reads. There's a lot of good reads that are consistent. This one's important to watch because if United Parcel Service is growing, that means the economy is growing. And if it's not, then what's going on? Why isn't there the volume of shipments going up? This one has had a hard time growing. So I'm sure they're going to try to show some growth, but it's really been flat. It was great during COVID when everybody was at home getting everything shipped to their houses, right? But now they're not finding catalysts for growth. If you can't grow, you're not going to have a good valuation and your stock's going to suffer, which is exactly what's happened to our friends at UPS. I have a soft spot in my heart because when I was in college, they were nice enough to give me a winter job, and I was unloading trucks. I'm sure some of you young guys may have done that. And they offered me a job on going, forward, but I was like, hey, sorry guys, I got to go back to school. And had fun working with them for one Christmas. Didn't have to go to the gym when I did that because, man, I would just be dripping sweat at the end of the night. Really good company. Very everybody's enjoys working hard there, and really good culture. Really enjoyed working there. So, yeah, these guys, man, they're kind of a little bit being run over by the market. Amazon's doing their own shipments and really taking away volumes away from UPS. So that is United Healthcare. So Peyton looks like KRYS. KRYS. Crystal Biotech. So, okay, cool. 4 billion. Looks interesting. If you want me to do a deep dive, $5 super chat, be happy to do it. This is right up my alley. I own a couple of stocks that are like that. And we can compare it to some of their peers. So let me know. Good one. PayPal. So these guys isn't like United Healthcare is like the stock. I'm like, man, I got to read that financials. I'm going to read through it. And the other one is PayPal. I'm expecting PayPal is going to catch a rally at some point because they're in the right space. They have a really good stablecoin business, and they announced today that they're going to accept like 100 different types of stablecoins. And they're going to be able to be kind of a super wallet and also integrate to wallets like Coinbase wallet and Robinhood's wallet and kind of be the payment platform for international payments. I thought that was big news. The market didn't move much on it. The stock was up like 0.3%. We'll see what they have to say tomorrow. It'd be really cool to see them flourish. But I'll be checking them out. Year to date, not good. 1 year looks better. These guys can use a rally. I think they're worth a lot more, but we'll see. We'll see what they announce tomorrow. Fiserv. So Fiserv, I don't ever remember analyzing Fiserv. What do these guys do? So payment systems. Okay. All right. And I think these guys are kind of old school. And I'd always be concerned with old school is being taken out by the new school players. Ooh, market may think the same. Yeah, these guys are not doing well. I like new school payment systems, and I try to stay away from old school. If you want me to analyze this guy, $5 super chat, and we will drill into it like we drilled into the stocks earlier. So think about it. All right, so we covered a lot of ground, guys. See if there's any news out there. So what's going on with the futures? They're ticking up higher. Nothing big here. It's a little bit higher. No crazy news out there that's going to tank the market. All right. All right, so I guess we'll just get up in the morning and watch those earnings. See what happens with United Healthcare. See what happens with um, AstraZeneca and Merck. Bookings is also going to announce tomorrow after the market closes. After the market closes, Visa, Starbucks, the market closes. But a lot of stocks, look at that. Before the market opens, like, geez, like 30, 40 stocks are going to announce. Electronic Arts. Yeah, a lot of announcements tomorrow. So, whew, overwhelming. It just keeps going. I'm not even going to click on another day. I'm already like overwhelmed. Cool stuff, guys. Well, so gold is, how's gold been doing? So gold is gone from like 2,400 to 33. Man, it's a nice move over the 1 year. And then year to date, had the move earlier, and then it flattened out. Cool. Sebastian, good to see you, man. It's been a little while. A cool segment would be reviewing viewers' portfolios. Yeah, that's a good idea. Um, and it'd be cool is reviewing a portfolio and kind of just getting a little bit of detail. So anybody wants to volunteer, we can do some pre-work. But a portfolio based on age and kind of do you like risk? Do you like buying stocks that are small and could like really just flourish, but some of them really die fast? Do you like that type of investing, or do you like, hey, I like buying, you know, blue chip stocks that move a little bit, but it's very predictable? You can kind of say that's the kind of investor I am, and totally look at it. I'd be very happy to do that. I think that'd be really interesting because every portfolio should be tailored around what you want to do. And when the thing that I've shared a couple of times, and I don't want to be a jerk about it, but um, the big Wall Street firms and the big like financial services companies, they kind of they don't want us to kind of learn. They don't want us to become great investors because they want us to be customers of theirs. They want us to be dependent on what they do, right? So they want to put fund managers to work and charge us 1% of our money. And I'm sure some people really get value from that. So I don't want to take away from that. But that's just not who I am. You know, I like figuring things out. I like challenges, and I like overachieving. I like doing better than just okay. So I'm saying that so that you get inspired to, be an individual stock investor, put in the rigor, get good at it, because it really is something that can really drive wealth at the end of the day. Be a great investor and you will drive your wealth. You'll be in control of making money for yourself through stock investing and other types of investing like crypto, real estate, and things like that. And that's an important thing. And when you look at what's growing really fast on Wall Street is the retail investing community. Robinhood being, one of the kind of like the focal points of retail investing. Retail investors are really showing up now, and they've always been there, but now retail investors are getting, and I think it's making what has been traditionally professional investors, kind of look like they're, especially the ones that are not very good, unnecessary. Because either you'll be a retail investor, really figuring out what's the ideal portfolio for yourself, getting smarter and smarter every day, every week, every month, every year, and really building that skill knowledge, ability to manage your money, or you'll be an ETF investor. But it's not going to leave a lot of room for those big firms on Wall Street to make a lot of money off of us. It's just not going to do it. So, Zubio, thanks, man. That was a cool interview. I really enjoyed it. I really appreciate Maurice giving me the opportunity to speak with him. He's a pretty smart dude. 4 algorithms. Whoa. Okay, so you're 22. So I like app. Okay, so let's go. What is CEG? Constellation Energy. Well, that was a really good pick because I really don't like energy, or utilities, but this one's really work because of the power demand from AI. So that looks good. AppLovin, ARM is good. AMOT is in semiconductor, Netflix, good. NVIDIA, AMD. Your growth. That's great. Now, what I would, so I like your portfolio for a 22-year-old. That's good. I would want you to define your process. What is it that you want to do? Try to document it and say, I like looking for companies that have this criteria, and this is going to be my scorecard. This is how I screen for that. And then revisit it every quarter. Like, okay, this is where I want to make money, because those are good stocks. Buying them at the right time, those are making a killer return. So those are really good names. Being able to repeat that, because you're 22, right? And when you're 26, can you then find the next kind of round of stocks that you would want to own? And if you define your process and begin to develop your skills around that process, you're going to be able to do it when you're 26, 30, 35, 40. You just need to keep getting better. So good stuff. All right, we got our first guy to put a portfolio out there. All right. All right, guys. So we've been rolling for an hour and 37 minutes. I think that's a good stream. Let's call it a stream, because I'm going to be streaming tomorrow. I have to figure out what time I can do it, but I'll try to give everybody notice. And then Tony, I honestly feel picking stocks is a must. Yep. So I'll try to stream tomorrow afternoon. We're going to have the member call in the morning, and I'll try to provide a little bit of notice, but it just depends on what I've got going on. And then Wednesday, I'm going to try to stream right after earnings come out for Meta, Microsoft, and same thing on Thursday when Amazon and Apple announce. I'll try to stream right after their earnings are announced. So look for those notices. I'll try to post them up on Discord, Facebook. The YouTube channel should advise everybody who's a subscriber. So hopefully you get notice. All right, everybody. Have a good night. Thanks for attending the stream. Really appreciate it. Hope you guys have a good night, and we'll see if we rally tomorrow. Got my fingers crossed that we have good, positive earnings. Thanks, everyone. Have a good night.